Okay, what I've tried to do on this board is condense the whole investment world and make it simple for you. So this piece of training material here, so to speak, that I've put together is just for training purposes only. And what I want to do is go back in time and bring you forward to why you're where you are right now. Years ago, when you started investing and you got your job and you started putting money in an IRA or a 401k or money that's after-tax money, and you started placing it in various investment accounts, where you started was typically in this center section here, and this is called brokerage. And you probably put your money in a 401k or an IRA, or you went to a brokerage place like Raymond James, Charles Schwab, Ameriprise. I mean, there's thousands and thousands, Morgan Keegan, Morgan Stanley, there's thousands of brokerage houses around. And you went in there and you got with a broker, okay, and he put your money in either stocks, bonds, mutual funds, variable annuities. And one of the reasons, okay, why you did this was because you were starting out and you didn't have a lump sum of money. So this is the way that you had to do it. So when you put your money here, okay, you invested and you saved. Well, over the years and over your lifetime, the market has grown. But in the last 11 years, we've been fairly flat. It wouldn't normally be a big deal, except that you're in your 50s and 60s now. And so when the market goes up, you want to capture as much as you can, and when the market goes down, you don't want to lose any of it. Or if you do lose some of it, you want to keep it to a very minimum. Now, if you know what a mutual fund is here, you know that if whatever mutual fund that you have, it has a ratio of equities and bonds, stocks and bonds in it. Now let's say, for example, that you have a mutual fund that has 70% stocks and 30% bonds. Well, as the market's going up, you're happy. If the market starts to go down, the bonds will stabilize, but the equities will lose value, okay? Now, in the past, since you've had all this time to ride the market up and down, it's not been a big deal, but time is condensed now. If you are in a mutual fund, and by the way, mutual funds are wonderful accounts, and they've gotten you where you are right now, and they'll continue to take you to where you want to be in the future, but there are a few little tweaks that you have to make. But if you follow this concept, this will come very clear to you. So as the market's going up, you're doing well. The market goes down, the bonds stabilize you, but you do lose some of your money. Now, in order to stop those losses, first of all, you would have to find out that the market's going down. And you would have to physically go in and sell that mutual fund as whatever the price is of 4 o'clock close today. Get out of that and go into one that is more heavily weighted in bonds. Well, that whole physical process of doing that, by the time you do that, the market's already gone down, okay? So when you're in a mutual fund, you're boxed in. It's like cookie cutter. You've got a prospectus. The prospectus outlines the costs and the fees, the disclosed. There are also undisclosed costs inside of there that you're not aware of. But you're boxed in there, okay? Now, this is the way that you've invested all these years. If you continue to do this, it's very difficult, because of the way that the market's moving right now, to minimize losses and maximize gains. Now, what I do, what makes me unique, is that I bypass this. I bypass the broker, I bypass the broker-dealer, I bypass all of this. In your mutual fund, there is a fund manager. And that fund manager manages that mutual fund. So I take you and I put you directly with the fund manager, bypassing all of this. Now let me explain how that's beneficial to you. A fund manager is actually who creates and manufactures the mutual fund for the broker-dealer. And that mutual fund is what you're in. Market goes up, market goes down. Unless you get out of that mutual fund and you go into another one, You're not going to be able to be flexible and move with the market. When you go to a fund manager, this is called institutional money management now. You're working with institutional traders and money managers. And the team that I use, they manage over a $1.7 billion portfolio. This is the way that it works. They have what are called models. And you got to remember, they manage money for banks, investment companies, and insurance companies. So they're managing these large portfolios for these large institutions, so they're called institutional level money managers. And it's only been in the last couple of years that these places have opened up their part of their firm to the private sector, to individual investment advisor representatives such as myself, which can bring it to you now. So, I put your money with the institutional money manager, and there's a team of them. There's one main money manager. He's the CFO, and he is managing a team of individuals who is actually doing the buying and trading. Now, here's where the interesting part comes in at. When you put your money in one of the models that are designed for you, say conservative income, that conservative income may have 20 to 30% bonds, 50 to 60% equities, the rest emerging markets and alternative investments. When the market's going up, however, they can weight that portfolio up to 15% heavy in equities. So they can ride the market when the market's doing well, and when the market's going down, they can liquidate a portion of that and move more into a conservative portfolio. So they have flexibility over here where you don't have here. So when you're directly with a model or with a money manager, they have the flexibility to actively manage and watch your account on a daily basis. And it's not just one person. They have a team of people that I use have a team of about 10 individuals. They literally, all they do is invest your money and they watch the stock market. And they have these Bloomberg screens that they set and watch 8 hours a day. And they're buying and selling and trading, and they're watching the market real time versus being in your house or being out playing golf or what have you, and the market goes down, you can't tell. So along with the sophisticated technology that they have with these Bloomberg screens, the team of individuals that they're using and the type of investment that you're using, which is a model, okay, instead of just a specific mutual fund. Inside the models, there are mutual funds and there's ETFs in there. But you've got a manager that's watching the market, a team of people that are watching a market, and they're moving money to try to capitalize on as much yield and gain as possible and minimize the losses. And because they are there real time and they're watching it, they're more in a proactive position versus a reactive position. So you can choose to keep investing like you've invested, but you don't have to do that anymore because you've acquired a lump sum of money, and now you can go and have it managed on a higher level with an institutional manager versus going and buying investments. So, brokerage, institutional. Now, you can't say the word guaranteed over here because over here your money's not guaranteed. The only accounts that you can say are guaranteed and safe would be CDs, of course, that you get at a bank. Fixed annuities, which are very much like a CD, but you get them through an insurance company. It gives you a fixed rate of interest for a period of time, gross tax deferred. So this day and time, these two accounts here, you're not going to make any money in those. Very low interest rates. Now, what came out in the mid-90s, and these are accounts that I used for years and years, and I still use them a lot, but as time has gone on, they've become more difficult for people to qualify for. Their suitability standards have raised. It's called a fixed indexed annuity. It's a fixed annuity, okay, that's got a fixed interest bucket inside it, just like your fixed annuity. But it also has a way that we can link your gains or the interest that's to be credited to your account to the stock market. And what happens here is, let's say you put money in your account, I would even probably split it up evenly among these, what I call buckets. One works well when the market's up, it takes a dip, but you think it's going to be back this time next year. There's an averaging strategy that works really well in a choppy market, more of a positive choppy market. And then there's a strategy that works best when the market is bullish. So the way the market moves this day and time, this is a safe way of capitalizing on market gains, most of the market gains, but not having any of the market losses. So your plan, if you came in to work with me, would be somewhere among this kind of account, depending upon your age, when you would need money, how much you would need, how much liquidity you have, as to how much we would put here, if we even put any here, okay? And somewhere on this side of the chart. Now there are multiple models, okay? And when you're with an institutional manager, they can actually build a portfolio to fit you. So you have a lot of flexibility and freedom over here. You're going to have some volatility, but because it's watched and monitored on a daily basis, you can literally go onto your account on a daily basis and watch what's happening. You don't have the volatility near that you have here. So this is an overall picture of the investment world, Sandy's investment world, where I've broken it down, and somewhere your plan is here and here. Occasionally we'll use some bonds here, but very rarely do we ever go into this area here. So this is my style of investments and my investment strategies. There are going to be other videos that you might want to watch. I'm going to go into more detail about the institutional level managed money and how it works. And I'm going to go in more detail about the indexed annuities, otherwise known, as many of you have heard, hybrid annuities. And I'm going to explain to you how all of these were formed and created. So I hope that helps you see the investment world as a whole and kind of give you an idea of what I do.